The world is on fire, and nobody is looking where it really matters. Every headline screams about the Middle East, chaos, and global fear. The media wants you glued to the Strait of Hormuz and the rising price of oil. But it's a lie, a distraction. The real story is in Japan. In 2024, after 17 years, the planet's biggest creditor ended its era of free money. The engine of the global economy is sputtering in Tokyo. And if you have a mortgage, a savings account, or a 401k, you're in the crosshairs. Chapter 1. The Demographic Black Hole. On the surface, Japan looks like it's already living in the future, a place where tech giants dominate the world stage, robots share the streets with people, AI predicts what'll come next, and entire cities run smarter, cleaner, and faster than anywhere else. But look past the distractions, dim the neon signs, forget the shiny gadgets. Focus instead on the finances, the numbers. That's where Japan's deepest, darkest, most disturbing secrets lie. The demographic death spiral. Because in 2026, Japan's population officially sits at approximately 122.6 million people. That might sound like a lot, but in 2010 it was even higher, 128 million to be precise. Since the late 2000s, Japan has been on a steady, unrelenting decline. It's losing around 500,000 people from its population every single year. That's like the city of Atlanta vanishing every 12 months. To make matters worse, Japan also has the highest proportion of elderly citizens anywhere in the world. In 2014, close to 26% of the population was over 65. By 2022, that increased to more than 29%. The population is getting older while the birth rate is hitting its lowest level in more than a century. Fewer and fewer people are choosing to start families. Birth rates are falling. Meanwhile, the number of people of working age keeps shrinking. It's reached the point where now there are 2 deaths in Japan for every birth. That is a problem for a lot of reasons, especially for the economy. Every year that these trends continue, Japan's tax base disappears bit by bit. With more retirees, fewer families, and fewer people paying taxes, Japan's financial foundations are starting to crack. But the Bank of Japan saw this problem coming, and they acted in a way that was desperate, dramatic, unprecedented. They made money free. Instead of raising interest rates to fight the problem, they kept them at zero. At times, they went below zero. At the same time, trillions of yen were pumped into the system. The Bank of Japan became one of the biggest buyers of its own stocks. In effect, it socialized its stock market just to keep the lights on. It was a gamble, one with a massive amount of risk attached. No other central bank of any major developed nation around the world operated the same way as Japan's. But somehow the gamble paid off, at least for a little while. People and businesses didn't have to worry about paying back much more than they'd originally borrowed. Loans became almost irresistible. Families took them. Businesses took them. Everyone wanted in. Why wouldn't they? It was almost like free money. Wall Street hedge funds and investment firms took advantage too, but on a much bigger scale. They realized they could borrow huge amounts of the Japanese yen at 0% interest and convert all of that cash to dollars. They would then use that cash to buy US tech stocks, treasury bonds, or anything else they wanted. It was known as the yen carry trade, and it was like some sort of video game infinite money glitch, a seemingly foolproof way to guarantee returns. For a while, Japan retained its status as an innovative, pioneering, and world-leading nation in more ways than one. But as gamers know all too well, glitches get patched. The system couldn't last. The so-called stability it provided was, in actual fact, little more than just a band-aid slapped hastily over a gaping hole in a broken economy. It was only a matter of time until that sticking plaster began to peel away. Private investments went nowhere, wages stalled, public debt spiraled, reaching a staggering 260% of the country's gross domestic product, or GDP, by 2022. Soon, the Bank of Japan was running out of options, so they went further, much further. They forced 10-year government bond yields to stay at zero. The country was borrowing at home for nothing and then exporting those profits around the world, hoping that the inflation would never rise too fast. But in 2026, that gamble is coming to an end. Now Japan is left with an incredibly big bill to settle. First, we want to thank the sponsor of today's video, Incogni. Have you ever searched your own name online and found way more than you expected? Your home address, phone number, email, even information about your relatives can end up on people search sites and data broker databases. And once that information is out there, it can be used for phishing scams, identity theft, harassment, or worse. That's why I decided to try Incogni. Getting started was simple. I created my account, selected whose personal data I wanted removed, and gave Incogni permission to work on my behalf. From there, Incogni contacts data brokers for you, sends removal requests, deals with the objections, and keeps you updated along the way. What I really liked is the dashboard, because it makes the whole process feel real. You can actually see the requests going out and track the progress over time. And after more than a week, it's much easier to see just how much work Incogni is doing for you behind the scenes. This feels especially important right now because major data breaches keep exposing personal information, and that data can be used to make scam emails, calls, and texts seem that much more convincing. I recently got one of those text messages saying a package couldn't be delivered and that I needed to click a link to fix it. And because I was actually expecting a package, it looked way more legitimate than it should have. That's the problem with having so much personal information floating around online. Even one profile left up can create real risks. Incogni also has a new custom removals feature on the Unlimited and Family Unlimited plans, so if you find your information on specific people search sites or another website, you can flag it, and one of Incogni's privacy agents will handle the rest for you. Go to incogni.com/TIS and use code TIS for an exclusive 60% off. Again, that's incogni.com/TIS, code TIS for 60% off. Chapter 2. The Widowmaker Detonates. The Bank of Japan had hoped that it would never come to this, and for years it didn't. Crisis after crisis hit, and somehow it held. But anyone watching closely knew it couldn't last. It was never a question of if the bubble would burst, only when. A bomb had been planted, we just didn't know how long the fuse was. Now we do. The explosion is here, and the spark that started it all was rising costs of oil and energy. In 2026, crude oil prices have surged by close to 50%, and it's having an impact all over the world. For a resource-poor nation like Japan, rising rates are a death sentence. As prices rise, central banks of countries all over the world have been forced to take action. In the US, rates still sit at 3.75%. It's a similar story in the UK and across Europe. But elsewhere, the pressure is building. Interest rates passed the 4% mark in Australia, 5% in India, and even close to 7% in places like Mexico and South Africa. And in the middle of all of this, Japan was trapped. On the one hand, it could raise rates but basically bankrupt its own government. It carries the highest debt-to-GDP ratio of any nation in the entire developed world. Or it could keep rates at 0%, but sacrifice the value of its currency in the process. Neither of these options was attractive, but the Bank of Japan had to pick one. It decided to persist with its 0% rate, and the results have been catastrophic. The yen has effectively gone into freefall. 5 years ago, in 2021, the yen was sitting at less than 110 to the dollar, but by late 2022, it was approaching 150. In April 2026, it's close to the 160 mark, hovering near its weakest point in decades. In just a few years, the Japanese currency has lost more than 30% of its value. For businesses, families, workers, it was devastating. Before they knew what hit them, salaries and savings were slashed. The money they had spent years earning was suddenly worth far less than it had been just a few years ago. It's just one of the ways the Japanese public has suffered. The cost to import goods to the country has also skyrocketed, leading to higher prices for numerous products and services. The more the Bank of Japan waited, the worse the situation would become. The yen would continue to spiral. They couldn't allow their own national currency to become worthless. They had to act. So, in a state of panic, policymakers made a decision almost 20 years in the making. They raised interest rates to 0.75%, with plans to increase them all the way up to 1% by 2027. It might not sound like much, and in isolation, it isn't. But compare it to the rest of the world, the US, the UK, Australia, rates of 2, 3, or 4% aren't uncommon. A rate of just 1% would actually be something of a freak occurrence. But for the Japanese financial system, 1% or even 0.75% is a seismic amount. It means that 17 years of free borrowing and free debt are coming to an end. And that doesn't just impact Japan and its people, it affects the whole world. For years on Wall Street, there was one investment strategy everyone had heard of. A strategy built on shorting the Japanese government bonds, betting that prices would fall and yields would finally rise. A gamble against decades of history, a bet that the Bank of Japan would finally break its own trend after years of stubbornly holding 0% interest. They called it the Widowmaker, and the name wasn't just for show. So many people who used this strategy ended up losing enormous amounts of capital because the Bank of Japan never did what they wanted it to do. It continued to maintain near zero or even negative rates year after year. But in 2025 and continuing into 2026, that all changed. The Widowmaker paid off. Trillions of dollars borrowed at nearly 0% in Japan have been flowing around the world, and now they're starting to seep away. The hedge funds and investors who were on the right side of the bet are making a fortune. Meanwhile, banks and firms that borrowed yen at 0% and poured it into risk assets or treasuries are scrambling to cash out while they still can. But while the top gets richer, the bottom pays the price. Everyday people, families, workers, and those who had no hand in the gamble are the ones footing the bill. Chapter 3. The Great Repatriation. This is the final nail in the coffin, the part that the media won't explain. They don't even want people to know about it until it's already too late. An event that is both catastrophic and almost invisible. A crash you won't see coming, but one that will shape the economic future of not just Japan, but the United States and dozens of other countries around the world. A shockwave that could be felt for years, even generations. The repatriation of the yen. The wealthiest and most important Japanese investors, including mega banks, pension funds, and insurance companies, are some of the biggest foreign holders of American debt. As a nation, Japan owns a whopping $1.2 trillion in United States treasuries. To put such an astronomical figure into perspective, $1.2 trillion is enough to fund the entire U.S. military for around 18 months. It's enough to end world hunger several times over. It is an insane amount of money, or to be more exact, an insane amount of American debt, all held in the hands of a single nation in a different continent. For years, it made sense for Japan's institutions to hold that debt. The Japanese Government Pension Investment Fund, or GPIF, is the world's biggest pension fund and has historically held on to a massive amount of foreign bonds. U.S. Treasuries made up 51% of its foreign bond portfolio in March 2025. There was a logic to that decision. U.S. bonds paid interest, while Japanese ones paid nothing. But now that logic is being washed away by the rising tide of Japan's interest rates. As those rates draw closer to 1% and the 10-year Japanese government bond yield surges past 2%, the math has been flipped. Why should a Japanese institution or pension fund like the GPIF continue to run the risk of holding America's debt while it could invest in its own government bonds instead? These companies, these banks, these pension funds no longer have the same incentive to chase returns abroad. Domestic investments finally pay off, and it doesn't take a financial genius to see the obvious. It is time to sell. We found data showing a quiet but growing exodus. Japan is cashing out. It's selling off its assets, dumping U.S. Treasury holdings at a record rate. That doesn't mean the entire $1.2 trillion will disappear overnight, but billions are starting to evaporate, and those billions can quickly turn into tens or hundreds of billions as the weeks go by. The ripples won't just stay in Japan. They'll spread across markets, across borders, across the Pacific. Because when the biggest buyer of U.S. debt bows out, who steps in to fill the void? The simple answer is no one. At least not at first. To attract new buyers and convince the world to absorb the debt, the Federal Reserve will be forced to act. Rates will have to go up. And when that happens, everything else is affected. Mortgage rates climb. Credit card interest rates soar. You're suddenly faced with spiraling costs. Everything becomes more expensive. Spending power diminishes and disposable income vanishes. Meanwhile, the stock market starts to bleed. Government bonds are far more attractive than risky bets like tech stocks. Money begins to move fast. For years, the yen carry trade was the grease in the wheels of the entire global financial machine. It kept everything running smoothly. It allowed those Wall Street hedge funds to borrow billions and pump it all into big businesses across America and beyond. Now those same funds are seeing their borrowing costs explode. They're backed into a corner, and they're running out of options. They're forced to sell their most profitable positions. Shares in companies like Apple, Nvidia, Microsoft, they're all dumped just to cover spiraling yen debts. This is the invisible crash. It doesn't dominate the headlines. It doesn't involve mass panic at the New York Stock Exchange or vast crowds of people protesting in the streets. It happens quietly in the background, and the world has no idea. Chapter 4. The Sovereign Debt Trap. We've reached a critical point in history, something the global economy has been building toward for nearly 20 years. And at the center of it all is Japan. It's pinned between two outcomes, both dangerous, both unavoidable. It is the ultimate sovereign debt trap. It either keeps interest rates low and protects its debt, but watches its currency collapse and its country starve, or it raises rates and temporarily saves its economy, but it sets its own national debt on fire, as well as detonating the entire global bond market. There is no out, no alternative option, no last-ditch magical solution. The fuse was lit a long time ago, and now it's reached the powder keg. The yen is just the first domino to fall, but it won't be the last. The dollar is next, and when that begins, everything changes. Which leads to a question the world has quietly been avoiding. What if the US economy crashes?